Impact of Federal Reserve interest rate hike on global economy. Federal Reserve officials signaled they could raise rates by a half percentage point at their meeting early next month and begin reducing their $9 trillion asset portfolio as part of their most aggressive effort in more than 2 decades to curb price pressures. Stocks fell and bond yields rose in the midst of expectations of a more aggressive Fed policy tightening process than previously anticipated. The US Federal Reserve announced its monetary policy after a 2-day meeting on 16 March and has approved their first interest rate increase in more than 3 years, raising their benchmark rate to a range between 0.25% and 0.5%. They also penciled in a series of additional rate increases this year to take rates closer to 2%, with inflation having surged to a 4-decade high. This development comes at a time when war clouds over Russia and Ukraine have intensified and impacted several key commodity prices, especially that of crude oil. The US has been battling a spike in inflation that hit 7.9 in February, a 4-decade high. The consumer price index has not been the highest since January 1982 when it hit 8.4. Most analysts expect the US central bank to hike aggressively over the next few months and see up to 7 hikes in 2022. Erin Captain of investment bank UBS expects the US Fed to start hiking by 25 BPS increments in March at every meeting until November 6th time to reach 1.5% before then pausing and resuming next year. So this aggressive US central bank policy action weighs heavily on global equity amid the geopolitical concerns. The Federal Reserve has the central bank of the world's largest economy. Every economic move that the Fed makes has immediate effect on the global markets. Interest rate hikes from the US Federal Reserve is likely to slow capital flows to emerging markets, weakening countries' currencies and economic growth, and potentially triggering credit risk at highly dollarized banks. Banks in Latin America and emerging Europe are most exposed to dollarization among developing economies, making them vulnerable to weaker local currencies and increasing withdrawals in the face of tighter US monetary policy. Raising interest rates will appreciate the US dollar, and in many parts of the world, the US dollar is used as a benchmark of current and future economic growth. In developed countries, a strong dollar is seen in a positive light, but circumstances are different in emerging economies. Now let's talk about the appreciating dollar. Aftermath of 2008 financial crisis, the Federal Reserve implemented years of quantitative easing to stimulate economic recovery, slashing rates to a near zero, where they remained for the next 6 years. The idea was to spur investments along with consumer spending and drag the American economy out of recession. Historically, rising interest rates have gone hand in hand with an appreciating US dollar. This in turn affects economic facets domestically and around the world, particularly the credit market, commodities, stocks, and investment opportunities. Credit market. The rising interest rates can be rooted in their contradictory effects on credit and money supply. According to Econ 101, higher interest rates lead to a decrease in the money supply and an appreciation of the dollar. At the same time, lending and credit markets contract. Global credit markets follow the movements of treasury bonds. Increase in interest rate will increase the cost of credit. From bank loans to mortgage, it becomes more expensive to borrow. The commodities market. Oil, gold, cotton and other global commodities are priced in US dollars, and a strong currency following a rate increase would increase the price of commodities for non-dollar holders. Economies that rely primarily on commodity production and an abundance of natural resources will be worse off. As the products of their principal industrial decline in value, their available credit streams will shrink. Stock market. Higher market interest rates can have a negative impact on the stock market. When Fed rate hikes make borrowing money more expensive, the cost of doing business rises for public and private companies. Over time, higher cost and less business could mean lower revenues and earnings for companies, potentially impacting their growth rate and their stock values. Dollar-denominated debt. Dollar denominated debt outside the United States currently amounts to $9 trillion, with emerging market amassing $3.3 trillion. Countries such as Turkey, Brazil, and South Africa, which perpetually run trade deficit, finance their current account deficit by building up dollar denominated debt. Fed interest rates hike while the dollar appreciates, the exchange rate between developing nations and the US will widen. As a result, the dollar denominated debt owned by developing nations increases and becomes unmanageable.